Welcome into Tax Tuesday. I'm your host today, Amanda Winalda, and I'm joined by
Elliot Thomas, Manager of Tax Advisors here at Anderson.
Nice. Toby is out.
Yes.
Probably doing something fun.
Nothing more fun than taxes, but
That's true. Not going to be having as much fun as we are today. So it's Tax Tuesday. What we do is we go over your tax questions. So you can send those questions into us at taxtuesday@andersonadvisors.com.
Correct.
Elliot will then comb through them. So send a lot in. He needs to stay busy. And then he picks out a handful and we go over them. So let's go over the rules. This is live Q&A via Zoom. So if you have any technical issues, you could put that into chat. We have an events team. We have some people in the background that can help with that. But if you have a question, a tax question, maybe related to what we're talking about, maybe not related to what we're talking about, you can go ahead and throw that into the Q&A. We have a lot of people here helping us today. So we've got Arash, Dutch, Jeff, Jennifer, Rachel, Tanya, Troy. All of them are CPAs, bookkeepers, really professionals that are going to be able to help you untangle whatever tax questions you have. And then if you need a detailed response, you can always email in. If you're an Anderson Platinum client, you can also send in a Platinum question or come into our Platinum Knowledge Room. Same type of setup and get individualized help.
And we got the YouTube going too.
Oh, that's right. We're live on YouTube. I believe Troy's helping out in the chat there. So send him in your questions. It is a little bit challenging answering questions.
That's why we have her do it. This is why we have the champ.
There's a character limit. How do I answer this complex tax question in less than 250 characters?
Not easy to do sometimes.
That's why Troy's doing it today. Okay, let's just go over. We're going to quickly go over the questions that we're going to be hitting on today. So can I rent real property to own my business?
Do we want to go through the questions or go ahead and answer?
We're going to go through the questions first. You read the next one.
Okay, just sold our primary California residence in July for $1,090,000. We purchased it 5 years ago for $650,000 with $300,000 down and a $350,000 mortgage. Any taxes due considering the 121 married filing joint exclusion of $500,000 capital gains.
Mm-hmm. That's a lot of numbers. They tell you when you go to law school you're not going to have to do math, and that is a lie. That is a lie. Could you give an example about cost segregation? I have heard you talk a lot about it, and they're kind of confused. I'm thinking about becoming a landlord. How can I do a cost segregation on, for example, the appliances that come with a purchased property? So that's a good one. Cost seg is always a popular one.
Yes. A lot of things to that. Is the 1244 stock loss provision a $50,000 tax credit that is dollar for dollar against your 2024 interest, Social Security, and passive incomes on your 1040 for 2024?
Lots of things to dig into in that one.
Yes.
All right, the next one will be, when using the accountability plan for a C-Corp, do the charges have to be made from the employee's personal account to qualify? And what happens if those charges are made on the company credit card? Ooh, commingling, we don't like that.
Nope.
For medical expenses, prescriptions, etc., if they were charged to the corporation credit card. We're going to go over that as well.
Mark that one up in red.
Oh, this is a long one.
We purchased our first commercial building this year. Even though I knew in the back of my mind the property was in an opportunity zone, it did not hit me until a couple of days ago. Is there still an advantage for us to go into the opportunity zone route? I believe the only benefit at this point is a 10-year mark and step up in basis. Is this correct? I believe there would be some elections we would have to make in a fund. Can you explain how it all gets set up and what we would need to do?
Yeah, opportunity zones have some great tax benefits, but can be complicated.
Yes.
All right, we are changing our LLC from being disregarded to being a C corporation. Over the year, we have moved substantial money from our LLC to our personal accounts as distributions. Do we need to relabel those as dividends, and would we be able to transfer the funds back? Or does the C Corp election only affect funds from the date of transition, meaning we'll file a split return, 1040 for a disregarded entity, 1120 for the C Corp? Thank you for all the great media you guys put out. Thanks, Elliot. You're welcome. I like how you left that part in. These are your exact questions. No editing. No editing done.
There's a little done, but not that part. All right, we have a rental property bought originally in 1991 as our residence. The current tenants want to purchase the property. What is the best way to approach this to lower capital gains? We are considering using the funds either to purchase another property or invest in tax liens and deeds.
Gosh, 1991 doesn't seem like that long ago,
Oh,
but
no, but it does.
it is the late 1900s. What are the tax implications of moving into a house that has been held as a rental for 12 years? They've never lived in it themselves. All right, we got a lot of good stuff coming up. You're on Toby Mathis's YouTube channel. He is TaxWise Toby. Please click subscribe. You'll get notifications when he comes out with a new video. Lots and lots of good stuff there.
It's got a few of those.
A few videos, yeah. They're like, him and Clint both get like those YouTube awards because
Right?
they're so influential. Clint Coons is our other founding partner. He focuses a lot on asset protection, although tax and asset protection, as we know, because we're Anderson, they hold hands in a lot of ways. So subscribe to him as well. And we've also got our tax and asset protection workshops. We call them the TAP workshops. The next one is going to be Saturday, November 23rd. You can register via these links. They're free virtual events. So it is a little bit of a commitment all day, but hey, I'm there all day Saturday and a lot of times, and we'd love to have you. We also have our live event coming up. We only do this 4 times a year. So this is the last one for this year, December 5th through 7th, in lovely Las Vegas.
Actually, Henderson, I think we have it going.
Henderson's part of Las Vegas.
Yes, it is.
It's actually still very close to the Strip.
It is.
Yeah.
It
So
is.
if you want a tax-deductible business meeting to Las Vegas, come
This
out and
is
visit
it,
us.
right?
We like to have fun. Although the attendees have much more fun than we do at those
Yep.
things when they're in Vegas. Yeah. They show up a little bit later every
Right,
every
every
morning.
day.
And then our last tax and asset protection workshop of the year is Saturday, December 14th. Actually, I think we have one more before the end of the year. Come and join us. All right. Can I rent real property that I own to my business? This is kind of one of those lawyer answers where it depends. Like,
It really does.
You can,
Yep.
but is it going to actually be tax-wise, Elliot?
Yes, that's the thing. First thing we want to look at is what we call the self-rental rules. And that's just a provision that says if you are renting to your own business, the general format there is that if you have overall gain, it's going to be ordinary. It's going to be taxed at ordinary rates. But if it's losses, it's going to be automatically passive. So that's kind of not fun. That doesn't usually work into our game plan as far as tax planning and things like that. But we want to be aware of that. Now, there is something else we can do called grouping. And grouping is a special election that you make. And let's just say you had a popular example that I actually think is in the IRS publication. Let's say you had a grocery store and you also own the land that the store is on. Well, you would put those, if you ever watch this one, Clint talking about the asset protection, we're going to separate those. We're going to put the land in one LLC, and then we'll have the operations, the store in this case, in maybe an S corporation or a C-Corp.
That's one of the key tenets of asset protection. You don't want to run your business out of the same entity that you're holding your assets. So, and that works across all kinds of industries, not just grocery stores, but
Right.
like residential assisted living. You hold the real
good
estate in
example,
one
yeah.
entity. You run the business out of another. We have a lot of clients who are doctors, dentists.
Yes.
They actually run their practice through typically an S corp, but then they also own the real estate underneath. So that applies to all of them.
Yeah. And if we group, then what that will allow us to do is to take the depreciation on that building against our ordinary income on our business. So it can be a really great tax event if we can make that happen. Now, there are some rules about grouping. It has to be an appropriate economic unit, and basically that just comes down to it makes sense. All right, it's reasonable that we put the two together, and then also you can't have an overabundance of impact from the rental as against the business, or vice versa. Or the thing that really allows most people to walk in the door, you have about equal proportional ownership for both the operational business and the land. And if we got that, then we can group and we can take advantage and we can get around that self-rental rule where we're limited to just passive losses or active ordinary income.
Okay, so when you read this question, you were thinking of like a
Self-rental rule.
doctor, dentist
Yes,
situation.
very much was,
I
right?
actually read this question as, can my business rent maybe like an ADU at my personal residence, or I have a rental property that's just a single family rental or an apartment. Can my business actually rent it from myself? Does it work the same way?
It really would. I don't know why it wouldn't. I can't think of, because you are doing effectively the same thing. You're renting something to your business. So I believe, yes, Yeah, you could.
Yeah.
You
You really got to run the numbers.
Yep. Yes, always, always, always calculate, calculate, calculate. The big mantra of Toby. Absolutely.
Yep. Calculate, calculate. Calculate again.
Yep.
All right. We just sold our primary residence. It's in California in July for 1.09.
Yes.
That's actually not that much for a California property.
Wow.
Average property value in California in 2023 was 850, almost 860,000. So, pretty good. They purchased it 5 years ago for 650. Now that is a lot of gain over
Right?
just 5 years.
That is very
So
California.
The down payment was $300,000, and it had a $350,000 mortgage. So, are there any taxes? So let's first back up, and what would you normally pay capital gains on in this situation?
So we're going to look at the sales price less our adjusted basis. Our adjusted basis in this case was the 650 we bought for. And if we had any improvements that we made over the year, we would increase that. If we put, let's say, 50,000 into a new addition or something like that. But here we just were given the 650, so that'd be our adjusted basis. So we subtract that from our 1,090,000, and we get
right?
440. Is that right? 440. There we go. It's right behind the camera. There you go. All right. So we get our 440. However, they talk about this 121 exclusion, and that's unique to our personal residence when we're selling that. And that says that, look, if you have a personal residence, you've owned it for at least, or excuse me, you've used it as a personal residence for 2 of the last 5 years and owned it for 2 of the last 5 years, and then you sell, you can go ahead and exclude up to $500,000 married filing joint. That's what they're referring to here. Or if you're single, 250,000. So we get to take that. We get to take the basis first, and then in this case, as long as we met those conditions, ownership and use 2 of the last 5 years, then they're going to be able to tack on another $500,000 deduction or exclusion here, which is going to put their gain at 440 minus 500, zero. Zero gain. So yeah, we will have no capital gain.
So it is an exclusion, it's not a deduction.
That is
Explain
correct.
how that makes a difference in this scenario.
Yeah, in this scenario, the exclusion just means I mean, effectively you get to the same place, but you just ignore 500,000, okay?
You can't go into the negative, though.
That is, yes, good point, yeah. A loss expenditure kind of deduction would create a negative amount here. Here the exclusion just says you just forget about it, but it's not going to create any kind of loss carryover or anything like that. Very good point.
Yeah, so the 121, the requirements are lived in it as your primary residence. So live, own as your primary residence 2 of the last 5 years. Those 2 years don't need to be consecutive.
No, they don't. Exactly
So
right.
it's 24 months. You can move in, you can move out, you can move back in, just 2 of the last 5 years. And then it's half of that. It's $250K if you're single.
Exactly
Single
right.
filer. All right. So in this case, the answer is
Yeah, we're good.
0 tax.
Absolutely.
Woohoo! All right. Can you give an example on cost segregation? I've heard you talk about it a lot and you're kind of confused. You are not the only one, so don't
Right.
feel bad. I'm thinking about becoming a landlord. How can I do a cost segregation on, for example, the appliances that come with the property I purchased? So first, we need to start this conversation by talking about depreciation and what depreciation is.
Exactly. In this case, excuse me, we're talking about landlords. So I'm going to go with a building, okay, a rental building. Then we'll talk about the contents later on here in a second. But the building, the normal aspect of it for depreciation is going to be what we call straight line depreciation. You purchase the building for X amount of dollars. Let's say, well, we go 500,000.
Yeah.
And we know that maybe 100,000 was the land, okay? So we got to subtract that out. That leaves us 400,000 for what we call the improvement or the building. And we're going to depreciate that over 27 and a half years, as Amanda is showing here, if it's a residential rental, or 39 if it's commercial. That would be your short-term rental type arrangement. So we look at that. We're going to take either those 25 and a half or 39. We're going to divide that into our 400,000 basis. And then we take that amount each year, we call it straight line depreciation, each year for 27 and a half or 39 years. But the situation here is that most will look at that bill and they'll say, well, now hold on. What's wrong here, Amanda? You got carpet, and that's 5-year
That
property.
does not last 27 and a half
No, it
years.
doesn't. And you got lights. We certainly have them here. We got wires, everything. And then you have a foundation. Those all have their own depreciation life. So what a cost segregation study does is they come in and they break it apart into the 5, 7, 15-year properties. And there'll be some that's 27 or 39. And they just kind of determine all that and break it into those pieces. And so right there, we've had a benefit because now that carpet's no longer deducted over 27 and a half years, but 5. And so we're speeding it up. We can often latch on something called bonus depreciation and speed up even more. But that's our cost segregation, how we break it into our pieces, 5, 10, 15, 27 and a half year property, or 39. But what about appliances?
Yeah, so to me, you don't even need cost segregation in this situation.
Right.
And so cost segregation study, you are hiring a specialized accounting firm. They'll come out, they'll do a lot of research based on what's on the public record, but then you can have them come out to the house and they literally go through and they count the number of shrubs, they measure everything. You could do it virtually via like a Zoom call, the same thing. But if you're just coming in and you're the landlord and you're just, say, replacing the refrigerator or replacing the stove, you don't need a full cost segregation study to accelerate the depreciation or take the full deduction for that in the first year.
That's right. Those appliances really aren't part of the house. So you're buying those independent as personal property. So you can go ahead and deduct those typically over 5 years. A microwave might be 5 years, a stove, refrigerator, what have you. So we don't have to worry about cost segregation in that situation. And in fact, if you buy one separately and it's under $2,500 and you make what's called the $2,500 de minimis election, then you can go ahead and expense that right away. You don't have to worry about any depreciation.
So if you're doing, say, you're doing like a full remodel, you can kind of do a cost segregation light. Is what I call it. If you're keeping track of everything that you're replacing and purchasing, you have the amounts there and you already know. You don't need the cost segregation company to come in and like pick everything apart into the individual property. You already kind of know because you've put it in. And so you you got a lot of options in terms of depreciating different appliances, different things, or in lieu doing a full cost segregation study.
Exactly. So the appliances were probably okay. The building itself, we may want to do a cost segregation. And of course, you always want to know what's the effect. Let's say either way you're deducting, you create a lot of losses. That doesn't necessarily mean you can take them. You always got to watch out for what your status is, if it's, say, real estate professional or passive, et cetera.
Yeah, if you just a regular W-2 active income and you're generating all of these losses on your rental properties per se passive. And so those two buckets don't cross over unless you meet some certain other specific conditions. Real estate professional status is one of them. So I would caution against doing a bunch of extra work if it's not actually going to benefit you on the tax side.
Very good.
All right. Next up is the 1244 stock loss provision of $50,000 tax credit dollar that is dollar for dollar against your 2024 interest, Social Security, and passive incomes on your 1040 for 24. So first, let's talk about the distinction between a tax credit and a deduction.
Exactly. A tax credit is what we're asked about here, is a dollar for dollar deduction against your tax liability. And that's really nice. So, a tax deduction is just a reduction against your income. It's an expense. You just take it as a deduction, but it doesn't go against your tax liability directly. So given the same amount, $10,000, do I want a $10,000 tax credit or $10,000 tax deduction? Well, as always, you're going to take the tax credit.
You don't usually get to choose, though.
No. Yeah, it's not a choice. It's no. But unfortunately here, the 1244 is not a tax credit. It's a tax deduction. Now, stepping back to what exactly is 1244, that's a special provision, and it only works with C corporations that have stock. So we're not talking about our friends, the LLC taxes a C. Those have units. They don't have stock. We're talking about what I call true C corporations with stock. Your Boeing or whatever. That's always in the press now, so I always use that one. But 1244 stock loss, we have some criteria maybe?
Oh, yeah. There's lots of criteria. So actually probably wouldn't apply to Boeing.
No, well, you're right. First of all, we got to be kind of tiny, less than $1 million.
Yeah, it's typically going to apply to your own corp that you started as a small business, maybe a management company. It's not going to be any stock that you're out buying on the stock market, the Tesla, the Amazon, the Apple. It's not going to qualify there. So it needs to be a smaller company.
We got to receive it directly from the company. So if Amanda started a C corporation, she's doing really well with it, and I decided I'm going to buy her shares, I don't get the 1244 stock treatment. She would because she got it directly from her business.
You have to be one of the original shareholders. It has to be a U.S. corporation.
Yes. Yep.
So you can't take your foreign corporation just because it's doing business here. If it ending up with a loss, you're not going to be able to deduct that from your U.S. income tax either. So U.S. Corp can't exceed $1 million when the stock was issued.
That's the capitalization, the value of the company. Let's see, then, yeah, it's only individuals typically that can get this. You can be a partnership, excuse me, and that can flow down to the partners if they're individuals. But typically, we only see it as individuals. There'll be people, not corporations or things like that can take advantage of this. And that's kind of the what qualifies for 1244. And then what it is, it's a loss, okay? And you get to take it as a deduction, not tax credit, a deduction of $50,000, and it becomes ordinary if you're single, or $100,000 if you're married filing joint. If we didn't have this provision, and let's say you had a $75,000 loss, you're married filing joint, that would be a capital loss. You'd be stuck at $3,000 each year for 25 years before you deducted all that. Unless you had other capital gains you could offset it against. But this was a provision to encourage investors into small business and not to be lured away from it because of that limitation. So they say, well, we'll give you a little bit that you can deduct as an ordinary deduction as opposed to those capital loss limits.
Yeah, so that's going to offset any ordinary income you have. So
Yes.
1099 contractor income, W-2 income.
Yep.
It reduces your total taxable income, which in effect reduces your taxes.
Yep. So the interest, Social Security, passive incomes, it's going to reduce any of those.
All right. But again, not an LLC tax
No,
as a C-Corp.
correct.
It's called the 1244 stock loss. So what do you need?
Yep.
You need stock.
Yes.
All right. When using the accountability plan for a C corporation, do the charges have to be made from the employee's personal account to qualify? And what happens if those charges are made on the company credit card? Ooh, the IRS police will come get you. For medical expenses, prescriptions, etc., if they were charged to the C corporation credit card. First, let's make a distinction between the accountable plan, which it sounds, and the medical 105B plan. They're technically not the same type of plan, even though mechanically speaking, in terms of the reimbursements not being taxable income to you, they work the same. But they are technically two different types of plans under two different portions of the IRS code. So the accountable plan covers things like phone, internet, home office, or administrative office, mileage, things like that. Whereas the medical 105B plan covers out-of-pocket medical expenses that by nature obviously are personal that your corporation can reimburse you for. So what happens if we use the company credit card for that?
Well, then we got problems. These things, these accountable plan reimbursements are just that, they're a reimbursement, which means the individual needs to pay for them first personally out of their own pocket for a reasonable business expense, and then they can turn it in to be reimbursed from the corporation, get their money back, corporation takes a deduction. Here we've kind of tried to cut corners and go straight to, well, let's just use the company card for these expenses that we know would have otherwise been available under our accountable plan, and that's a no-no, because now we used that term earlier, I think it was commingling.
Yep.
What's going on there?
Don't want to do that.
No, we
want to
don't.
commingle. So not only is this bad from a tax deduction standpoint, but the reason we run our businesses through separate legal entities is to limit our liability and talk about piercing the corporate veil. And in order for the courts to maintain your company as a separate and distinct entity from you, you have to also treat it as separate and distinct. And one of the main things you want to avoid doing is commingling your personal and your business expenses. So using the business card to pay for personal expenses. We don't want to do that directly. So even though the company can reimburse us for some of our personal expenses, our phones, our internet, our medical expenses, those are personal to us. So we need to use our personal funds first. We need to do expense reports. I know that sounds time consuming. You don't have to do it every time you have an expense. I personally just do them at the end of the year when it's time to go through taxes. Could do it all in a couple of hours, and then your company can reimburse you. For medical specifically, you also don't want to use any HSA plan because the IRS is really not going to let you double dip. The HSA is already a tax deferred or a tax preferred account that you're saving funds in to pay for medical expenses, so you can't double dip that with then reimbursing yourself also from the C-Corp.
Very good point. And we just happen to have a question here about using the business card for qualifying meals. That's something else, okay? Yeah, your business can pay directly for those meals, and that's fine. It gets 50% of that. Or you personally could pay for it and then turn it in for reimbursement. Either way, we get to the same spot.
Yeah.
Good
So
question.
what's the distinction when we're thinking, should I use my personal card first versus the company card? Because a meal seems personal.
Yes, I think when in doubt, pay for it personally and then try and reimburse it. But it's got to begin. It's got to be something out of your own pocket for a reasonable business expense that you paid, and then you turn it in for the reimbursement. But you know, your operational expenses, generally, your C corporation would pay for that itself. And so, in a while, I think after doing this, it will be kind of second nature. You know which one you should pay by the business card, but you can always reimburse as long as, again, it's for a good business expense. You can reimburse that. It doesn't matter what it's for. So you're always safer there, and then you'll get gradually used to knowing, like, well, for 280A corporate meetings, something like that, you can get that paid for directly by the C Corp.
All right. We purchased our first commercial building this year. Congratulations.
Yes.
Even though I knew in the back of my mind the property was in an opportunity zone, it did not hit me until a couple of days ago. Is there still an advantage for us to go the opportunity zone route? I believe the only benefit at this point is the 10-year mark and the step up in basis. Is that correct? I believe there would be some elections we would have to make and a fund, capital F. Can you explain how it all gets set up and what we would need to do? So let's talk about what opportunity zones actually are, because they haven't been really popular for a few years. So opportunity zones were created as part of the Tax Cuts and Jobs Act. Each state was responsible for designating certain areas, and these were usually dilapidated areas. They could be rural, they could be in the city. Each state was able to choose. So even in Vegas, we have some spots just north of here in downtown Las Vegas. And the idea was to generate investment in those places, bring business, bring jobs, bring renovations and things like that. Very similar to what they did with the Gulf zones, which were part of the rehabilitation of after Hurricane Katrina down in New Orleans. And so what you're able to do in those zones is you can take gains from something else, from selling stock, from selling real estate, and similar to a 1031, roll those into an opportunity zone. And so what were the tax benefits of using these opportunity zones?
Yeah, so when this originally started, we were able to, it comes from your capital gains. You're going to put those into the fund. We'll talk a little bit more about that. And then you would get a stepped up basis, an artificial basis of a total of 15%. It was 10% if you started 7 years out before 2026. Then it became 5%, I believe it was 2 years later. So a total of 15%, you get this artificial basis. So if you sold or incurred anything in between, then you'd only pay tax on 85% as opposed to 100%. But as our questioner points out here, if we hold on to the whole thing for 10 years, then we get a massive step up. And if you sell it then, there's no capital gains on it. One important point I'm missing here, remember you had capital gains, you invested them, and they're deferring this. It's a deferral only up to the end of 2026. And at that point, then you will have to pay the tax on that capital gains. So it's a temporary deferment on those capital gains. But the rest of the project, if it goes up in value, after 10 years, you won't pay any tax on that increased value. And that's kind of how the tax part of it works.
So at the most, you're deferring some of the taxes a couple of years?
That's correct.
Maybe 1 year?
And as we get closer to the end of 26, it really lost its luster, okay? We're well past that 15% basis break that we got, the 10 and the 5%. That's gone. And now really it is only that stepped up. You're going to have to pay the tax at the end of 26 anyway on the capital gains you deferred. And really it is, as you point out here, only the 10-year mark that you get to step up basis. That's really all that's left. Yeah.
So other than whether or not from a tax perspective, this would actually give them any benefit, I am concerned about the timing, because if you purchase the property, the commercial building earlier this year, an opportunity zone has to actually be set up in a specific way.
Yes, you got to put those funds into an opportunity zone fund, which has to be a partnership or a corporation, S or C. Okay, we put the funds in there, and then you can go out and get the property, what we call the opportunity zone property. So you get the house, let's say. Once you do obtain that property, then a stopwatch starts, and you have 30 months to substantially improve it, they call. And so if an example, let's say that it's a $10,000 house that you bought in some area, you'd have to at least double that up to $20,000 of value. You have to substantially improve it. If it was barren land, then you've got to put a certain amount into a house on there, and it can't just be a shack. There's certain, the regs go into a lot of detail on some of those things. So again, we set up the fund. It's a partnership or a C corporation or an S corporation. You put your capital gains, or at least the dollar amount. It doesn't have to be the same from your exact transaction when you sold your capital asset, but you put that dollar amount in there. It goes out, buys the property, and then we can start that deferral. But again, it ends at the end of 26.
Yeah, I don't think you would necessarily be able to back into it this way. Like, purchase a property with capital gains funds and then realize it's in an opportunity zone.
Oh, wait,
And then be like, oh, I'm going to claim these tax benefits. You had to put the funds into the opportunity zone fund, which is the business entity, and then purchase the property there. You're not going to be able to back into it.
And we do have, when we get there to the time to do the tax return, every year you have to self-certify, the business does, that it qualifies. It's called Form 8998. And you fill out every year, and that's just self-certifying that, hey, yeah, we qualify as an opportunity zone fund. So you'll be doing that for a while. It goes on the tax return, including extensions. All right. And so that's kind of the background ways of doing it.
Yeah. Doesn't sound like it's going to work for this guy.
Yeah.
Trying to find my cursor. All right. We're changing our LLC from being disregarded to us to being a C-Corp. Over the year, we have moved substantial money from our LLC to our personal accounts as distributions. Do we need to relabel those distributions as dividends? And would we be able to transfer the funds back? Or does the C-Corp election only affect funds from the date of transition, meaning we'll file a split return? Thank you for all the great media you guys put out. All right, so an LLC, for just basic background, an LLC can be taxed as disregarded, which means for tax purposes, the government, the IRS doesn't see it. All of that income expense shows up on your personal 1040, either Schedule C or Schedule E. And then it can also elect to be taxed as a C corporation or an S corporation by filing an 8832 entity classification election. And so you can, it's pretty big change though, disregarded to a C corporation. So looking backwards, they're asking about all of the funds that their company, their LLC has earned in the past that they then took as a distribution. That wasn't necessarily a tax, that actual transfer of funds from the LLC to them wasn't a taxable transaction. Does that change now that they're becoming a C Corp?
Nothing happens with the previous activity, but as our questioner asks or points out here, there's a transition point where we became a C Corp. Now going forward, we can't just take money out. Then we do have taxable events going on there, be it wages or dividends. But prior to that, the fact that they took money out, that's what they're supposed to do in the sole proprietorship. That's fine. It's going to show up on the Schedule C, Schedule E, as Amanda pointed out, and they pay the taxes there on their 1040. No worries there. Yeah. You're good. And no, you do not have to put the money back in when you turn into a C Corp. That would be awful. Yeah. But no, you do not. So we're very good there. But once you're a C corporation, it's not your money anymore. It belongs to a C corporation. It's a separate person. We can't be taking that out. That gets into something called fraud if we try and steal them, or theft when we try and take money out. So unless it's taxable via dividend or W-2 wages, there can be reimbursements for things like an accountable plan, for administrative office, or the medical reimbursement plan, or even corporate meetings you can be paid. That would be ways you could cash out, but that's a little bit different. Certainly they're not dividends. Sure.
Yeah, so I think this question asker hit it on the head with the split return. So when you fill out the form to elect to be taxed as a C Corp, there's going to be an effective start date you list on that form. Everything prior to that, all the taxation, all the distributions, all the contributions will be on your disregarded LLC, and then everything moving forward will be on your C corporation. What about any initial capital contribution they put into the LLC that is still in the company? What does that turn into?
So when we do this, the C election, effectively, you're taking all the assets, putting them into the C Corp, whatever's in that LLC, the disregarded LLC, in exchange for stock. So it now owns it. So that value becomes the value of your stock. It becomes your basis in your stock going forward. So we take everything, rip it out of the sole proprietorship. I understand it's the same LLC, but we are changing it from a different type of LLC into something that's very unique, a corporation. And so you put in and you get your stock back, and that all becomes your basis in your stock.
Yeah, because now you have stock.
There you go.
Well,
I guess that was it.
All right. We're going to plug our tax and asset protection
who's this
event.
guy?
If the taxes and the legal really get you going, come out to our day-long tax and asset protection workshop. That's a virtual webinar. We have attorneys, we have CPAs on there, so you can listen, you can ask your own questions. That's going to be November 23rd and another one December 14th. We hold them about twice a month. So we have people who come for the first half one weekend and then come for the second half the next weekend. It's usually asset protection in the morning, tax in the afternoon. So whatever gets you going, you can come in. And we also have our live tax and asset protection event this December 5th through 7th in Las Vegas.
Yes.
Technically Henderson, but it's the same. We're in Las Vegas. It's about 10 minutes from the airport. So super convenient if you're coming in, plus totally tax deductible as a business expense. So come and see us. All right. We have a rental property originally bought in 1991, or the late 1900s, as the kids say.
Yep.
The current tenants want to purchase the property. What is the best way to approach this to lower capital gains? We are considering using the funds to either purchase another property or invest in tax liens and deeds. You got a lot of, if you're seller financing, you could, depends on how the tenants want to purchase the property, but you got a lot of options here, I feel like.
Yeah, to lower our overall tax, you certainly could do something on an installment where you just receive a little payment over time. And there you would only recognize a little bit of tax just on that single payment.
And interest.
Yes, and interest.
So
correct.
that's what you think of as a seller financing. So
Yeah, I
you
think
take
it'd
a down
probably-
payment, and then you're just recognizing you're spreading the total gain across however many years you want to seller finance that for.
Exactly right. So that'd be a nice option, just a little bit of tax each time. Or alternatively, the probably the bigger would be a 1031 exchange. You get an immediate deferral, indefinite, unless they change the rules. But right now it's indefinite, and often what will happen long term, thinking long term, a parent may do a 1031, leave that to their heirs later on when they pass, and they get that stepped up basis. Very nice option there. So I think the installment, I think the 1031 probably are your best. As far as tax liens and deeds, if we did something like that, we're going to incur that tax immediately this year. So that would probably be your worst option, I would think, because you're not going to defer on a lien or a deed, I don't think.
When you're doing a 1031, you need to reinvest in like-kind properties. So tax liens and deeds aren't necessarily going,
Right.
they're not going to fit into that category. So you can't 1031 from a rental property to tax liens. Can you do like a DST?
You could, Delaware Statutory Trust, that's a popular option. A little more complicated, but yes, it could be done. Or even the, I always forget
The REIT?
yes, the UPREIT, the uniform, what is it? I can't remember what the U stands for, but Partnership Real Estate Investment Trust, that's what we're going to do. Umbrella partnership. And that's something where those would all, the ST, the UPREIT, 1031, those are things that could theoretically, depending on how the math works out, permanently defer that for a long time. Whereas the tax liens and deeds, again, you're going to have to recognize that income immediately. So that would probably be your least tax-friendly option. Installment sale, as Amanda pointed out, very good option there too. Yeah.
And this analysis is just solely based on this. You could have other capital gains activity, losses, gains going on in other places on your tax return that would offset the gain. So you really need to look at your situation holistically.
And just one more point here. You mentioned that you originally purchased in 91 as your residence. So let's say we didn't start renting until very recently. Well, then we get into that 121 exclusion. Yeah, so that could be a play. I kind of jumped to that. Maybe we haven't had a residence for a long time, but that might not be the case. What if we bought this or just turned it into a rental, let's say in 2022? As long as you meet the 2 years of ownership, 2 years of using it as your personal residence within the last 5 years, you would have probably a really good exclusion there of up to $500,000 married, filing joint, 250,000 single. So that could be in play here too.
Yeah, that's true. 121.
Yeah.
What are the tax implications of moving into a house that has been held as a rental for 12 years? Man, people are holding their property a long time.
Yeah.
Held as a rental for 12 years. They've never lived in it themselves. And so 121 off the table because that's only for your primary residence. So moving into a house that's been held as a rental for 12 years.
So here, really the only tax consideration is now it's your personal residence, but we kind of want to know what the basis is. What's your value in it? Now, when you originally purchased this house, let's say it was $100,000 and you made some improvements for 50, so it was 150,000, but you took depreciation for maybe 100 over these years, so it leaves you with an adjusted basis of 50. That becomes your basis now that it's your personal residence. So we want to know that. You want to have that calculated out just so, if you ever sold this property or did something else with it, usually that you're very busy with that transaction. You want to know what your adjusted basis is, or at least have a rough idea of it right away. So you want to calculate that, kind of knowing in your back of your mind what your adjusted basis is, because that will carry over to you in your new, well, not new house, but your new residence.
Yeah, and now that it's your residence, quite a few things are no longer going to be deductible.
Yes.
So it's not business use property, so you're not going to be able to deduct, at least against the property taxes, the mortgage interest, utilities, all the things that you normally deduct, repairs. So if something breaks, you just got to pay for it, no deduction available. For property taxes, if you're itemizing on your Schedule A, then you do still have the state and local tax deduction. It's limited to $10,000. So if you're in an area where property taxes are quite high, like California, New York, you may bump up against that limitation. So you do get some deduction there, but most people aren't itemizing these days. The standard deduction's pretty high. It's going up to $15,000 per person next year. So if your property tax, you probably aren't going to be getting a deduction for those property taxes there. Is there a way, just to get creative, if it's a rental now, could they make all kinds of repairs that individually fall into this 2,500 safe harbor? Maybe they need to redo the bathroom or replace some appliances. I mean, it's been 12 years. But they still leave it as rentable. They still leave it as listed. Could they make those, deduct them, not get another tenant, and then move in after the fact and still be able to deduct those costs? Or is that kind of pushing the line?
I think that's pushing. Yeah, you want to still run it. And the thing that always scares me about rehabbing and doing a lot of repairs, if you do have a tenant in there, is the liability. Thus, that's why you keep it separated. You keep it in a box, an LLC, to keep it protected, because now you got nails and boards and saws and things like that going on, and you have tenants living there. It's a good mixture for a lawsuit.
So yeah.
Yeah.
Not as many deductions if they need to, say, replace the HVAC or repair the roof, should they do that now while it's still a rental property?
That's what I would do.
And then you still get to deduct it,
you always
or at
want,
least add it to your basis.
Yeah, you still want to do the calculations, but I would think I'd probably want to do it before, while it's still a business, so I get a little benefit there, because while it's going to increase your basis once it becomes your personal residence, who knows when you're ever able to take advantage of that. If you're going to hold on to this a long time as your personal residence, well, then you may never see that benefit. So I would try and get it done first.
What happens to all of the depreciation they've taken over the last 12 years? Do they have to recapture that right away, or do they?
No recapture on that. Yeah, that gets
They still hold off on that recapture until you sell the property.
Exactly.
Nice. Nicely done.
Yep. All
right. So this is Toby Mathis's YouTube channel. Please like, subscribe, smash that subscribe button, as the kids say. TaxWise Toby, it's all tax asset protection. And then our other founding partner here at Anderson Advisors, Clint Coons, they throw up a couple of new videos a week. So
a ton. And it's all good. It's all good content.
It is. We sometimes can't even keep up with it.
And they got a heck of a sense of humor. So.
And final plug. because we really just want you to come see us
Yeah.
out here in Vegas for our live
Vegas.
event, December 5th through 7th. Totally tax deductible trip. It's Thursday, Friday, Saturday. So
believe
if
so.
you,
And then they have the mixer.
yeah, that we're doing a new, what is it called? Client networking event. And so you can network with other clients. We have a lot of clients who do all different types of investing. And so you get with them, people put deals together.
Yeah.
I met at our last event in San Diego a group of 4 individuals who are Anderson clients that come from all over the country, and they come to our events as kind of their like girls trip. Like they all come in from different
There you go.
places. They hang out for the weekend at, it's usually a pretty nice hotel, and then they just get going
Yeah.
on different deals and stuff. And we
Absolutely.
also have our one-day live webinars. Those start at about 9 a.m. Pacific and go to about 3:30 Pacific. But next one's on November 23rd, and the next one on December 14th. Those are about twice a month. Those are great because we give really good deals at those things.
Yes.
We get
Yeah.
really good deals. If you're a seasoned investor and you need to get an entire asset protection structure set up, if you're just looking for tax help, or if you're just even brand new, we've got something for everyone.
Go value shopping. Right?
Questions. If you have a question and you can't make it to Tax Tuesday, just email us, taxtuesday@andersonadvisors.com, or visit us at andersonadvisors.com. Again, we're going to stay on until all of the last 8 questions are finished up, but come see us. We do this every other week, right?
Yes.
I don't do this every other week.
Oh,
Elliot is the star.
No, she's the one rocking it behind the scenes and the YouTube. So yeah, that's hard to handle. You get all those coming in.
We fix it in post, as they say. We fix it in post. That's
But we got our other teammates here. You know, what we got here? We got Matthew, Jason, Jennifer, Kate, Arash, Dutch, Jared, Jeffrey, Jennifer, Rachel, anymore. It goes on.
Yeah, Tanya and Troy. So thank you so much for joining us.
Yeah.
Let us know if you have any more tax questions. We'll see you next time. Take care.